This video will help you understand how a securities-based line of credit works so you can decide if it's right for your portfolio. If you don't know who I am, my name is Chris Dime. I'm a certified financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. As wealth accumulates for clients, it's not uncommon that when they wake up in their 50s and 60s, they're gonna have different pockets of money spread out all over the place. Outside of retirement accounts, they might have accumulated non-retirement assets, and by way of things like brokerage accounts, maybe a joint investment account, or maybe a concentrated company stock account. For example, if you work at one of the major technology companies and part of your compensation is through some type of equity compensation, restricted stock units, options, etc., you might have amassed a large concentrated stock position, and as you continue to march through life, it's not uncommon that things are going to pop up, emergencies, kids' education, whatever, and rather than selling out of appreciable shares, aka a portfolio that's been accumulating and probably will continue to accumulate over time, it might make more sense to set up a line of credit based on the value of that portfolio and borrow from that for whatever expense we're talking about. Now, of course, everybody's situation is a little bit different, and I know when talking about borrowing from an account to pay for something else, a lot of folks might have their anxiety rising because they do not like borrowing, and I get that. However, sometimes the math is pretty compelling that rather than paying capital gains tax, for example, and selling a bunch of stocks out of a particular portfolio, it might make more sense to set up a line of credit based on your portfolio, use that to pay for whatever expense we're talking about, and then replenish that line of credit over time as the cash flow shows up. And rather than dive into securities-based lines of credit myself, I figured why not just go direct to the source with someone who works in this space all day long. One of the professionals I've worked with is named Dustin Carnevale, who works at Bancorp, and they set up securities-based lines of credit all the time. And so for this video, we did a quick interview on how these work so you can feel more informed. So without further ado, let's jump in. Dustin, you want to take a quick moment, introduce yourself a little bit to our audience?
Yeah, thanks, Chris. So Dustin Carnevale, I'm the Vice President for the West Coast region for the Bancorp. We are a publicly traded, nationally chartered bank that provides liquidity and banking services to independent financial advisors and their clients.
Cool. And I know we've worked together in the past on a couple of different cases. And today I thought it'd be great just to extract all your knowledge for our listeners on how securities-based lines of credit work. But before we get into the specifics on SBLOCs, as they're called, colloquially, maybe you could share high level how these fit in compared to maybe some other classic lines of equity that exist out there, home equity lines of credit, stuff like that.
Sure. Yeah, they're similar in that they provide clients the opportunity to leverage, an asset, right? In the HELOC, it's a home. For margin, it's their non-qualified investment account. So it's similar in that apparatus. However, it's far more streamlined. It's a simpler process. We don't require nearly as much as traditional loans or HELOCs, et cetera. And then we provide a level of flexibility and then banking support behind that clients traditionally don't get when they go, a more traditional loan or HELOC or margin route.
A little bit more maybe customized hands-on service and ongoing service rather than set it and forget it. Well, I guess the purpose of today's call is to talk about SBLOCs or securities-based lines of credit. Can you share high level how these work and, why a client might be interested in setting one of these up?
Yeah, absolutely. So I think we'll start with why a client would set this up, right? We find from time to time unexpected expenses come up, weddings, tuition, tax bills, et cetera. We're seeing a lot more in the real estate market now that the real estate market is a lot tighter and hotter out west where clients have, maybe some savings or they've got investment accounts that have appreciated over the years, but they don't have a lot of cash available, right, for an emergency or for real estate transaction, et cetera. So what this allows clients to do is leverage or collateralize their investment account to provide them with the cash liquidity they need for, a specific scenario. The terms are much more flexible and the line of credit is at the client's discretion. So it doesn't come with some of those burdensome, payments or amortization over 30 years, et cetera. It's much easier for clients to make flexible payments that work with their schedule and their cash flow as opposed to being locked into something.
I think that's pretty attractive. Like academically, setting up some 30-year amortized loan, it's simple on paper, but then when you actually get in the trenches with clients, I think that flexibility can come in handy. So it's good to know that these securities-based lines of credit give you that. Can you share maybe some just ballpark figures? Hey, got a client who's got we'll just keep it simple, $1 million non-retirement investment account. what might they be looking to be able to set up as a line of credit on an account like that?
Sure. Yep. So we again take a similar but more conservative approach. We tend to lend somewhere between 50 to 65% of the market value. We determine that on a case by case basis. It has to do with the diversification and the allocation of the account, what assets are invested in, et cetera. But we find that's kind of our sweet spot is at 50 to 65%. What that allows is clients to unlock the value of that account while not overexposing them, right, to any market fluctuation or potential, downturns in the market. That if we lended more, right, it would narrow that window, and clients could be a little nervous. We'd honestly be a little nervous as well. So we found that that's probably the sweet spot where everybody feels comfortable, and we feel comfortable, clients feel comfortable, et cetera. One other distinction for securities-based lines of credit versus a HELOC or something more traditional is we don't have a requirement for financials, right? We don't ask for tax records, we don't ask for financial statements, salaries, et cetera, right? It's secured by the assets in the market. So on a personal level, clients don't have to divulge or dig up any of the personal things or documents that usually come with something like this. From a size perspective, it's relatively simple. Since we do lend that 50 to 60% of the market value, if a client has, $150,000 in the market, they typically qualify, right? So it's a low hurdle for entry. So if you need a smaller line of credit for something, that's available to them. And then really the sky's the limit, right? I mean, there's no max or cap. So depending on what they have available and what they need, we'll usually lend, as much as they need.
And it sounds like there's quite a bit of conservatism built into only allowing the client to set up a line of credit on 50% of the account balance, because, theoretically, if they had a line of credit for 80% of their portfolio and then 2008 hits and their portfolio drops by 20%, okay, well, now their loan is the entire value of their portfolio, which means that they could potentially be in the water, if I'm understanding the metrics.
That's correct. And that's a good distinction that we draw against not only something like margin, but also our competitors, right? We're one of the few banks that weathered both the 2008-2009 crisis and this most recent, kind of COVID pullback without clients having to suffer any sort of clawback or call situations, right? Everybody was comfortably collateralized. And so we didn't have any concerns. Our clients were all kind of safe throughout that process, which is nice.
Well, you said a trigger word right there. You said margin. Maybe for our audience, can you share, because, margin's out in the news. You've got movies like Margin Call, whatnot. And a lot of times clients hear margin, and, it can be concerning if they've gone through 2008 where, borrowing on margin was a big factor. Can you share how this is different than margin?
Yeah. So what a margin loan or line does is it allows clients to do something similar, right? It allows them to borrow against the market value of their investments. 9 times out of 10, you can obviously speak this a little bit better, clients then use that to buy more securities, right? They buy more assets in the market, right? So they're really double leveraging themselves up, right? So they're borrowing against the value of their investment, and then they're investing that in other, volatile, right? Securities that change in value from day to day or month to month. And so that really makes that a risky endeavor where they are subject to market fluctuations that could really impact, both their current investment strategy, but then how much they owe. And what happens is when those things go poorly, they end up, losing that initial investment as well as having to sell some existing securities to pay the debit back. Yeah. While we do collateralize and lend a percent of the market value, the clients are not allowed for regulatory reasons, and it's actually a nice thing, to invest SBLOC money into the market, right? So they're not double leveraging with an SBLOC. They're using the securities-based line of credit for something else, paying down higher interest debt, paying for tuition, paying for real estate, private investment, right? So it's much more stable, much more secure. It's not subject to market fluctuations. So it operates the same in how it's accessed, but it's what is done with the funds that makes the real difference. And from our perspective, not investing in the market eliminates that risk altogether and allows them to know comfortably that they're not going to lose the value of their accounts based on something they spent the money on from the SBLOC.
Yeah, I mean, that brings me some peace of mind if a client wants to borrow and then go do something else with it, that these are specifically designed not to have a client double down on, say, some super volatile stock market index or whatever, but they can use it for, investing, if you will. But it sounds like more private investing that maybe can't change every 24 hours based on the whims of, what somebody tweeted halfway across the globe, right?
That's correct. Yep. And we see that from time to time, right? Especially, in the last couple of years where the market's done pretty well, right? The market's returning, maybe 10+%.
Yeah.
So the opportunity to borrow at a lower rate and then get that market appreciation helps to reduce or minimize the real sort of interest rate clients are paying. And so they've been able to invest in safer, long-term investments and assets, maybe their business, right? Things like that.
Yeah.
And then allow the market to appreciate and use some of that to minimize what their interest payments are like.
You said another thing at the very beginning of our call on based on what the clients invested in their portfolio, that might dictate how much they can or can't borrow. Can you touch on that with maybe some hypotheticals of a 100% stock portfolio versus 100% bond versus 100% concentrated in like one particular security?
Sure, yeah. So again, we take a very conservative approach to the bank corp. We like for everybody to sleep well at night and no one to feel nervous or overextended. And so we will lend basically 50% of an equity value. That's your traditional stocks, right? Your Microsoft, your ETF of an S&P index fund, something like that, right? Kind of vanilla. We typically lend a little bit more on more conservative assets like investment grade fixed income. Those are things like municipal bonds, right? Corporate debt that's very safe, et cetera. And then government bonds, right? That falls in that category, right? So if a client is invested in something a little more conservative, a little safer, right? We tend to lend a little bit more because there's less volatility. We're not as concerned about the market value of that asset moving around enough. So what we see in a traditionally diversified portfolio of stocks and bonds and sort of a composite of both is that 50 to 60% lendable or advanced value. To your question, we do have a lot of clients in the West Coast. There's a lot of people who have been benefiting from stock options and whatnot throughout their career. So for those concentrated positions, we will lend less. And while that could seem a little burdensome, it's really in the best interest of the client, right? We, again, don't want to overextend or over leverage their assets and their investment, and then are subject to, a change in the market value, which could have some negative ramifications. So because of that, we tend to lend maybe in the 20 to 30% value for a 100% concentrated portfolio. Again, that's all to protect the client and to prevent any sort of market fluctuations from having a negative impact. Traditionally, we will take that on a case-by-case basis, right? So it's not a blanket approach. It depends on the specific stock, what's going on in the market, et cetera. But we look at all that very, very closely, again, to protect the clients and make sure that their investment strategy stays intact and they're not opening themselves up to any undue risk.
So it sounds like simply the more risk your portfolio is assuming, the more risk the bank has to assume. So you're not going to get as favorable of line of credit percentages as far as value is concerned.
That's correct. And again, we monitor these on a daily basis. We have a long-standing and close relationship with the custodial partners that hold these accounts. So if a client diversifies, during the course of the line of credit, or they rebalance on a quarterly or biannually basis, the line of credit actually fluctuates to match both the market value and the allocation. So if a client decides after setting up a line of credit that, they're really benefiting it from it and they could use a little bit more, and maybe that matters more than the investment allocation that they had, started with, they can move into something more conservative and move some money around to give themselves more liquidity and more access on the line of credit side and reduce the market risk of the portfolio.
Gotcha. So if a client is more attracted to borrowing more or setting up a larger line of credit, and that trumps being overly concentrated in one particular stock, they could always move from a concentrated position to a more diversified position and bring more peace of mind to the bank and therefore get a higher line of credit on the same balance.
Yep, exactly. That's correct.
Gotcha. Okay. Well, we talked a little bit about percentages. That's a hot topic right now with where interest rates are at here in 2023. Can you touch on how the interest rates factor into an existing loan, maybe what you're seeing by way of typical percentages for what clients are borrowing at today, and kind of how those mechanics work?
Yep, absolutely. So our interest rates are tied to a very stable, long-standing interest rate called Wall Street Journal Prime. It's been around for decades. Most people are familiar with it, and we do find it to be the most stable and predictable rate. So
Okay.
we will use that as our base, and then we will subtract a spread or subtract a certain amount from that base based on the size of the line of credit. So clients can expect to see a interest rate for their lines of credit anywhere from that Wall Street Journal prime rate minus 25 basis points all the way down to minus maybe a whole basis point, right, depending on the
Hmm.
size of the line. Um, that Wall Street Journal prime interest rate does change when the Fed makes a change to their interest rate, right? So every time the client opens up the newspaper, right, or turns on the TV and hears that the Fed, raised or lowered rates, they'll see a correlating change in their interest rate. But historically, that's been a very stable, very predictable rate. And I imagine once we get through this inflationary cycle and rates stabilize or even start to go down, that interest rate will start to fall as well. We find that is a better bargain for the client because it's, again, predictable and stable, as
Hmm.
opposed to some of the other metrics that other banks use that change daily or monthly, which can be, a little frustrating, maybe a little confusing when a client gets a statement every month and their rate is slightly different than it was the previous month. We try
Yeah.
to avoid that by choosing a more stable, predictable rate in Wall Street Journal Prime.
Under the table, this is how the bank is getting paid, right? For assuming the risk of setting up a line of credit for the client.
That's correct. Yeah, it's traditional lending for us, right? The interest rate is the rate at which we make money, right? So, whatever the interest rate is on an outstanding balance, that's
Hmm.
our net interest, right? That's how we're
Hmm.
making revenue. It's good to keep in mind, though, that these lines of credit, again, as I said earlier, are at the discretion of the client. So they're under no obligation to use them. We see a lot of clients set these up for in case of emergency, or they set them up for a specific opportunity or investment, et cetera, that maybe doesn't come to fruition, and they don't end up using the line of credit. It doesn't cost the clients anything if they never use it. So while we do make money when they do use it and there's an interest, they're under no obligation to do that, and there's no costs or fees associated to these. So if they don't ever use them, it doesn't cost the clients anything. And when they do use it, they are allowed to make interest only payments for as long as they like, and principal repayments are entirely up to the client. So unlike your traditional loan that's or mortgage that's 30 years and you have a set amount every month, ours are set up so that you can make a flexible payment and pay the interest only if that's what's comfortable, or you can pay the interest plus some principal, etc. Right? But it's all at the discretion of the client. What we also see is maybe quarterly, biannually, just depending on their compensation or investments they've made. Some clients will choose to make lump sum payments once or twice a year, something like that. Some like to spread it out on a monthly basis, but the repayment plans on these are completely flexible and available to the client to set up for however they you know can best manage that.
So if I'm understanding correctly, theoretically, a client could pay the interest only for as long as they want. They would just never be completely out of this line of credit. They'd still be in debt to the line of credit until they start making those principal payments.
Yeah, that's a good way to look at it. It's not too dissimilar from a credit card, right? It's a crude analogy, but it tends to resonate with most individuals, right? When you get your statement every month, there's always a minimum amount due. And as long as you pay that, everything is fine. You can continue to pay that as long as you need to. There will be a remaining principal balance, right, to your point. But that principal balance is up to clients as to how and when they want to pay that back. So if they want to pay a little more some months and a little less others, depending on what's going on, that works perfectly fine for us. We don't ask that they make a specific amount or set payments.
I guess that could function pretty well. Like if, for example, like Microsoft comes out in, I believe, September that with all their cash bonuses, and that could be a really good time if a client was maybe borrowing from, the equity in their investment account and they wanted to make a large principal payment and they know it's upcoming, they could just make interest only payments until fall time frame and then make a big lump sum on the principal and maybe completely be done with the line of credit.
Yep, exactly. That's correct. We see that often, especially with a lot of West Coast based clients. We also see it a lot in the real estate space where the offer on the house was accepted. That's fantastic in this market. That's hard to come by. But their current home is still on the market, right? And they don't have a timeline as to when that's going to be paid off. So they use the line of credit to make the down payment, or maybe just buy the home outright on an all cash offer. And then they can make interest only payments or actually choose to just roll the interest while their current home's on the market. And then once it sells and they get that cash windfall, they use that to pay off the line of credit. That's become a very common practice out here in the West Coast.
So we touched on earlier about some of the tax ramifications of selling out of some concentrated positions. Can you talk about what the tax ramifications or advantages are of using an SBLOC for a client situation?
Sure, certainly. Yep. So again, one of the advantages is you're avoiding capital gains, right? I think that's primary number one, right? Clients don't have to sell out of the market. They don't have to put themselves in a taxable event. From a taxable or tax deductible perspective, it really depends on how the lines of credit are used. We are a bank. However, we're not the tax accountants, right? We're not client CPAs, et cetera. And so we always defer to the clients, right? Please, have this conversation, bring this to your CPA, your tax attorney, et cetera. And depending on the use, right, that will dictate whether or not these end up being tax deductible. What we see a lot of times are physicians will set these up and use them for their business, or investors use it for real estate investment, et cetera. So those are opportunities where it could be tax deductible, especially if it's used for something like that. But it really just depends on a case by case basis as far as how the line of credit is used by the clients. On the flip side of that, these lines of credit are also not debt. Because they're collateralized, they don't go on a credit report. They're not reported to the bureaus. So unlike other traditional lending options, they aren't a drag on a credit score. They don't show up on a credit report, so that if they ever did pursue something else, maybe they're getting a mortgage in 6 months or a year, or they apply for something in the future, this line of credit won't negatively impact those individuals or their credit reports, which is a nice plus.
Like indirectly, without even thinking about taxes, I can imagine how simply just applying for, a loan somewhere could ding a credit score and then potentially have deleterious long-term downstream effects, right?
Yep,
That's
exactly. Yeah. And thankfully, these lines of credit just aren't set up that way. Again, because it's collateralized, because the market value of the collateral is significantly higher than the line of credit. It doesn't qualify as debt in that sense, and so it doesn't get reported. So it's a lot of clients appreciate that, right? They don't want to be dinged just because they needed to leverage, a line of credit for something.
Well, as we get ready to wrap up, one more question came to mind before we kind of transition to some calls to action for our audience. We talked a lot about borrowing from an investment account. Can you clarify which investment accounts you can set up SBLOCs with and which ones you can't?
Certainly, yep. So as long as they're not retirement accounts, right? So IRAs, 401ks, et cetera, right? Those are not eligible,
Okay.
mostly because, the regulators are trying to keep clients from double leveraging on retirement money, right? That's a critical nest egg for a lot of individuals, and they want that to remain in place and not put under any risk. And so if you have a taxable, right, a brokerage account, an advisory account, something like that, if it's taxable, if it's not included retirement, those funds are what are eligible for the SBLOCs.
And we touched on this the other day in a sidebar conversation, but cash value life insurance policies too. We'll have to save that for maybe another video, but you can collateralize the cash value on a life insurance policy too, right?
Exactly. Yep. Similar. We offer the same thing on whole life policies, universal life policies, et cetera. And it's the same principle. Cash value accumulates in those policies, and we allow clients to tap into that value for a line of credit while just retaining the policy, the dividends, and the policy growth that they need.
So as we prepare to wrap up, can you share, what someone would do if they're interested in diving deeper into potentially setting up a securities-based line of credit on their own portfolio?
Sure, certainly. So the Bancorp is partnered with independent financial advisors across the country. And so our relationship is with the advisor and the firm. So if a client is interested, the first thing they should do is schedule a meeting or call their financial advisor and talk about this on a preliminary basis, right? I'm interested in this. I've heard about it. What do you think? And can we take a look at the portfolio and make sure that this is right for us, right? We always want clients to feel comfortable and know that this is the good option for them based on their long-term investment strategy, based on their allocation, et cetera. The Bancorp has long-standing partnerships with LPL and their advisors. And so we have a streamlined, very integrated application and process. in the event clients want to move forward. We set up lines of credit for individual accounts, joints, trusts, entities, right? So if a business account, an LLC, et cetera, and even nonprofits. So if a client wants to pursue that in concert with their financial advisor, they would reach out to us, and then we would set up a very brief phone call to make sure that they understand the ins and outs. We get all their questions answered. And then from there, the application process is all online. It's very streamlined. It's very fast. We can typically set these up in a few days to maybe a week. Yeah. And then the clients have access to their funds via an app with us. They have online banking as they would with any bank. We provide checks as well. And then we wire funds on behalf of the client for free to anywhere that they like the funds sent. So the entire process from initial conversation with advisor to line of credit approved and ready for use can be just a matter of days. And then once it's set up and approved, we offer all the traditional banking services for clients, right? So if a client needs to change their address, order more checks, has a question, et cetera, the Bancorp's customer experience staff is there to support the end client as well with all of those sorts of things. So they have a whole suite of resources through our bank, through you and through myself to access, to ask questions, to pursue opportunities, et cetera. And so we try to take a holistic approach and give them all the tools and resources they need and make it all available at their fingertips in this, typical, modern digital space we operate in.
So as we transition to close, is there anything else you think our audience should know or that you want to share before we call it a day?
Sure, thanks. I think just for clients to understand just the flexible nature of this, how it is set up at their discretion, and is provided for the client. I think that's probably the most important thing to know. We at the Bancorp are a client-first organization, and we really value our relationship with the financial advisors and their clients. And so we are here to support them in any way that makes sense for them.
Sounds like a strategy that clients should definitely be aware of. Thanks for joining on our call today. Have an awesome rest of your week.
Thanks, Chris. You too. Take care.
So hopefully that was helpful in better understanding how securities-based lines of credit work, how they function, and ultimately give you a better understanding of whether or not you should factor one of these into your financial plan. If you think you're moving in that direction, obviously speak with your financial advisor because they're going to have the connections to set up one of these. If your financial advisor doesn't have a connection, let me know and we can make an introduction. And of course, if you are interested in setting one of these up and you want to bypass your financial advisor altogether, you can go directly to the source at Bancorp. We'll link them below. Of course, there's no affiliation or official partnership I have with anybody at Bancorp. It's just been a successful relationship over time. If you have further questions, drop them in the comments below or get in touch on the website. We'll help you get squared away. Other than that, have an awesome rest of your week. Bye.